Good to have you. In the U.S., the red-hot financial markets pause for breath today as America celebrates the Independence Day holiday. Investors have other reasons to cheer. The U.S. economy entering its longest ever growth spurt earlier this week. But how long can it last? Many are bracing for a weak employment report on Friday and even an interest rate cut later this month. And Britain's economy appears to have shrunk for the first time since late 2012. Between April and June, as worries about Brexit were compounded by global trade tensions. That's according to a newly released industry survey. British gross domestic product last shrank from one quarter to another in the final 3 months of 2012, according to official data as well. Now, the last time GDP shrank for 2 or more quarters in a row, the widely accepted definition of a recession was in 2008 to 2009 during the global financial crisis. And a Rise business correspondent, Laurie Laird, joins us now. It's good to have you, Laurie, and good afternoon. It's been a record-breaking week on Wall Street. What's been happening there?
Well, you're absolutely right. Record-breaking closes on all the major U.S. equity indices, and now they're all up in double-digit figures year to date. The NASDAQ Composite Index up 23%, the Dow Jones Industrial Average up 15% year to date. So it has been an incredible year for the stock markets, and this in a week, Nihi, where the U.S. surpassed its longest expansion ever, so the longest period without a recession ever recorded in the U.S. So it's been quite a week on the U.S. financial markets. But I think as much as Donald Trump will love to talk about, brag about the level of the stock market, the high level of the stock market, it's an odd metric for him to have chosen as a measure of his presidency. Only about half of Americans are actually invested in the stock market. What I think will be more important for Americans is the rally that we're also seeing in bond prices. Now, a government bond is essentially a way that the government uses to borrow. It sells its debt on to investors with a promise to pay them an interest rate, and along with the principal at the end of the length of that, the life of that financial instrument. Now, a lot of people thought that when the government really increased its borrowing to finance Donald Trump's tax cuts, that means the government would have to borrow more. There would be a bigger stock of government bonds out there. Therefore, the extra supply would lead to a depressed price. That hasn't happened at all. People are still buying bonds. When the price of a bond goes up, the yield comes down. Now, the 10-year bond is now yielding below 2% a year. That's the lowest that we've seen in 3 years, and that may have a bigger effect on more Americans than the rally in the stock market, because so many loans are priced off the 10-year note. Things like credit card debt, things like mortgage debt are priced off the 10-year and the 30-year bonds. As the yields on those bonds move down, that means consumers may face lower interest rates as well.
Indeed, Laurie, interesting development there. But what's the reason for the enthusiasm?
This all comes from the expectation, Nihi, that the Federal Reserve, which sets interest rates, the central bank in the U.S., is going to cut rates at its meeting at the end of this month. And the markets are so convinced that the Federal Reserve is poised to cut interest rates that they're debating whether it will be a quarter-point cut or a half-point cut. A half-point cut would be a pretty dramatic cut. Remember that interest rates in the U.S. are now in a range of between 2.5% and 2.75%. So a half percentage point off of that would represent a really sharp rate cut. That is the reason that some of the interest rates have moved down. When short-term rates move down, and that's what the Fed sets, it sets an overnight rate, then longer-term rates play off of that. So you'll see a chain reaction, if you will. If the Fed cuts rates on its overnight rate, then bill rates, 3-month bills fall, 2-year note bond fall, and so down the interest rate curve. So that's the reason for this excitement in the bond and stock markets. The reason people think that the Fed may cut interest rates is because there's a real belief that the economy might be slowing quite dramatically. The data haven't borne that out yet, but the feeling is that the economy is going to slow. Whether that's because we have passed this big milestone of the longest recovery ever, or whether that's because underneath the headline data that we've seen, there really is a slowdown, that's not entirely clear yet.
Indeed, Laurie. Now, we have some crucial data expected tomorrow. What do you make of it?
Well, we've got the U.S. non-farm payroll report for the month of June coming out tomorrow, and this is an economic release that is sort of first among equals of the releases that come out of the government and the government departments. And there are a couple of reasons for this. One is because it's the first official data we get that looks at the previous month. We only came into July on Monday, and at the end of this week we will have the look at the employment situation for June. So it's the earliest data point that we have in any given month. It's also very symbolic if you think about the purpose of economic growth. It's to create jobs and to give people the means of earning a reasonable wage. So that's why the employment report is so very important. Now remember, we had a much, much weaker than expected employment report in the month of May. Only 75,000 jobs were created. That's well lower than many people expected. Yesterday we had a report of private sector job grades. This is not official data, but this was also weaker than expected. So I suspect that some analysts will be marking down their forecast for the official data tomorrow. Expectations now about a rise of about 160,000. That would be a pretty good report. It's well below the job creation number of over 200,000 that we saw through most of last year. But with the unemployment rate so very low at 3.6%, I think employment gains will be much more shallow than we have seen, simply because many, many people who want a job are able to find one and are employed right now.
Very good, Laurie. It'll be interesting how President Trump will tweet on the latest job data, as it were. But not all central bankers are planning to vote for a rate cut at this rate. What do you make of it?
Well, this is something that's interesting to point out, Nihi, because while Jerome Powell, who is the head of the Federal Reserve, has been dropping some pretty heavy hints that he thinks rates are going to go lower quite soon, there isn't unanimity on that view on the Federal Reserve Board. And I spoke with Loretta Mester earlier this week. She's the president of the Cleveland Federal Reserve Board. That also makes her a member of the FOMC, the Federal Open Market Committee. That's the organization that sets interest rates. Now, she will not vote on the setting of interest rates this time around. There's a sliding scale on who gets to vote and who doesn't, but she'll certainly be part of the deliberations at the next FOMC meeting later this week. And she was pretty clear that she doesn't think that the economy needs a rate cut right now. She admitted that the economy is slowing a bit, but slowing from an elevated rate of growth. She sees the economy returning to a trend rate of growth of about 2%. We were up above 3% over the past couple of quarters, but to her mind, 2% growth is perfectly respectable. It's in line with the trend rate of growth, and she doesn't see any need for an interest rate cut yet. She did say if you throw in a couple more weak employment reports along the lines of that report we saw in May, that gain of only 75,000, then she might change her mind, but she certainly is not supportive of a rate cut right now.
Indeed, Laurie. And just before you go, I'd like your thoughts on the UK economy as a no-deal Brexit possibility looms. What do you make of it, briefly?
Well, I think that there are obvious signs that the UK economy is weakening, and weakening quite dramatically. Now, these PMI, Purchasing Manager Indices, that came out yesterday are not official data, so take these data with a grain of salt. These data don't measure how much stuff was produced. They measure sentiment. The way these PMIs are compiled is that an organization called IHS Markets surveys purchasing managers at a range of firms and asks them, did you buy more raw materials this month? Did you buy more petrol, more paper clips, computer cables, whatever it is, whatever your raw inputs are? Did you buy more or less? And from those answers, an index is compiled. Roughly, if that index is over 50, that points to expansion. If it's under 50, it points to contraction. What struck people yesterday is that the service component of that index was into that contractionary territory. But again, take this with a grain of salt. This number is not measuring the level of services provided. It's measuring sentiment of purchasing managers at service organizations. That said, there certainly are signs that the economy weakened. The GDP for the month of April contracted 0.4%. That's a big contraction. We will not get the second quarter economic data until later this month. So we're going to have to make do with this kind of anecdotal survey evidence until we get that official data.
Indeed, we'll wait to how this all pans out. Laurie Laird, I'd like to thank you for your thoughts on the US and UK economies. Good to have you.
Thanks, Nihi.